Hey everybody, and welcome back to Sip and Talk. It's definitely a big one, huge economic news dropping, and I know you're all about getting to the heart of things without wading through a ton of jargon and data.
Exactly. No one wants to get bogged down, right? So we rolled up our sleeves and dove headfirst into this whole reciprocal tariffs thing the U.S. just announced.
Analyses from all angles. We even got our hands on the transcript of the actual announcement.
The whole shebang. And our mission today is to break it all down, make sure everyone listening really gets what these tariffs are, who they're going to hit the hardest, and why it matters to, well, pretty much everyone.
And this is where it gets really interesting right off the bat. It's not just a simple policy change. It's got these layers. You've got the immediate rules, the explanations for why they're doing it, and then a whole wave of reactions and potential consequences that economists and market analysts are already debating.
It's a lot to unpack.
It is, but the sources you sent, they really paint a complete picture. We can actually connect the dots between what's being said and what might actually happen in the real world.
Okay, so first things first, let's lay down the groundwork. What exactly did they announce?
Right, the nuts and bolts.
From what we've pieced together, especially digging into the Far Eastern Economic Review article and that comprehensive Rusum report, this new tariff plan has two main parts.
Two-pronged approach.
Yeah. First, there's this blanket 10% tariff on almost everything coming into the U.S. from other countries.
Pretty much everything, yeah.
And that's set to go into effect on April 5th, 2025, just a few days from now. Then there's the second part, these personalized reciprocal tariffs.
And those are specifically targeted at countries that have a big trade surplus with the U.S.
Right, so they're not hitting every country equally.
Exactly. These are more like, okay, you're doing this to us, so we're going to do something similar back to you.
It's like a tit-for-tat thing.
And these kick in a bit later, on April 9th. And this is where it gets really interesting because, as that White House graphic from the dual-cone video showed, these rates are all over the place.
Oh, yeah, the article and report break them down, and it's a lot. China's getting hit with a total of 54%.
Which includes that previous 20% tariff plus a new 34%.
Oof, yeah. The EU is looking at 20%, Japan 24%, South Korea 25%, Taiwan 32%.
And Vietnam, they're facing a pretty hefty 46%.
So Vietnam's getting hit harder than some others.
Yeah, it really varies depending on who we're talking about. But here's the thing. They're calling these discounted reciprocal tariffs.
Discounted.
Yeah, like a sale on tariffs.
Yeah.
The idea is the U.S. is saying, we're only charging you about half of what you're charging us. At least that's what they're claiming, based on what we heard in the Druido transcript.
Okay, so how are they even coming up with these numbers?
Right, so the Far Eastern Economic Review explains how they're calculating this. It's basically, they take the U.S. trade deficit with a country, like how much more stuff we're buying from them than we're selling to them.
Okay.
And they divide that by the total value of the stuff we import from that country.
So bigger trade deficit, bigger tariff.
Exactly. But, and this is important, that formula led to them initially slapping Taiwan with a 64% tariff.
64%, that's a lot.
It is, and it's raised eyebrows. We're talking experts like Professor Anson Soderberry from Purdue University, openly questioning if that calculation even makes sense economically.
So not everyone's buying it.
Not really, and it's not even just about existing tariffs other countries have in place. The White House, according to the Far Eastern Economic Review, they're also lumping in things they call non-tariff barriers when they came up with that 64% number for Taiwan.
Non-tariff barriers, what does that even mean?
It's basically anything that makes it harder to sell American goods in another country. Think things like really strict regulations, complicated customs procedures, even subsidies that favor local companies. And during the official announcement, which we saw in the jury's transcript, the president listed a whole bunch of grievances about trade practices. They're talking currency manipulation, VAT taxes, all sorts of stuff. He even gave some specific examples like how Thailand puts a 60% tariff on motorcycles while the U.S. charges way less, or how the EU slaps cars with higher tariffs and VAT compared to the U.S.'s 2.5%. It was pretty clear he sees this as a way to level the playing field.
Yeah, it sounds like he feels the U.S. has been getting a raw deal for a while. But what about stuff that's not getting hit with these tariffs? Are there any exceptions?
Absolutely. There are several big categories that are totally exempt. Steel and aluminum, for example, they already have tariffs under Section 232. Same goes for cars and car parts. Then you've got copper, pharmaceuticals, semiconductors, wood, gold, energy products, certain minerals. They're all off the hook.
Interesting. So why those specific things?
Well, it seems like they're trying to be strategic, not just shutting down all trade. Maybe focusing on areas where the U.S. feels it has leverage, or where putting on tariffs wouldn't hurt American consumers or businesses too much. So, hitting where it hurts. But why are they even doing this? What's the whole point?
Well, the sources are pretty clear about the stated goals. The Youytube report and the Youytube transcript both lay them out. Basically, it boils down to protecting American manufacturing, shrinking the trade deficit, giving the U.S. more power in trade negotiations, and encouraging companies to produce more stuff here in the U.S.
So bringing jobs back home.
Exactly. And they're really pushing that message. I mean, the president straight up claimed it Liberation Day for American industry during the announcement. He said this is a huge step toward making America wealthy again. He was really hammering home the idea that for too long, other countries have been taking advantage of the U.S. in trade deals.
Makes sense. The Tariff report goes into detail about how a lot of economists are really worried about the potential for a global trade war. Basically, other countries retaliating with their own tariffs and things just escalating from there.
Yeah, that wouldn't be good.
Definitely not. They're also worried about inflation going up for everyday people like us. They even pointed to how washing machines jumped up 34% in price after those previous tariffs. So we could see similar price hikes on other stuff.
That's the last thing we need.
Right. And they're predicting negative impacts on the overall economy, too. Goldman Sachs, for example, estimated that a 25% tariff could push inflation up by 0.7% and actually shrink GDP by 0.4%. It's a big deal.
And we're already seeing the market react.
Oh, yeah?
The report mentions that on April 3rd, Lululemon stock dropped like 11-12% because people are worried about their supply chain in Vietnam. And Deckers, the company that makes UGG boots, their stock fell 14%.
Yeah, it's already having an impact. Asian markets felt it too. The Nikkei, Kospi, ASX 200 all saw declines.
Wow, so people are definitely nervous about this.
And it's not just businesses. We need to think about how other countries are going to react. The report mentions some countries are already talking about retaliating, and we even saw reports that French President Macron met with U.S. officials to try and avoid a trade war with Europe.
So things could get messy.
They could, but it's not a uniform response. Mexico's President Sheinbaum said they're not planning on retaliating with their own tariffs. So it really depends on the specific relationship each country has with the U.S.
Okay, so everyone's kind of waiting to see what happens next. But the Jew transcript also mentions some interesting stuff about specific companies. Like Apple, for example, is apparently planning a huge $500 billion investment here in the U.S.
Huge.
Right. And it's not just them. Other tech giants like SoftBank, OpenAI, Oracle, NVIDIA are also planning big investments.
It's interesting, right? Because while there are all these concerns about the negative economic impacts, the administration is clearly hoping this will incentivize companies to bring manufacturing back to the U.S.
And the transcript even highlighted TSMC, the massive chip manufacturer from Taiwan. They're reportedly investing $200 billion in the U.S., and they're suggesting it's at least partly because of these tariffs.
It does seem like a pretty big carrot to dangle, right? Avoid the tariffs, come build factories here.
Yeah, and the transcript even included some comments from a UAW supporter who was super enthusiastic about this. They believe these policies are going to revitalize American factories and create a ton of new jobs.
It definitely aligns with the whole message of bringing back American manufacturing and making America great again. And it's not just small potatoes either. The transcript even threw out a figure of $6 trillion in potential investments being planned.
$6 trillion? That's wow.
Of course, we'll have to wait and see how much of that actually materializes, but it definitely shows the scale of what they're hoping to achieve.
So for everyone listening, what's the bottom line here?
Well, this is a major shift in U.S. trade policy, that's for sure. The goal is clear. Bring production back to the U.S., fix these trade imbalances that they see as unfair.
But there are definitely risks involved. We're talking potential price hikes, trade wars with other countries. The long-term effects really hinge on how other countries respond and how these policies actually play out in practice.
Exactly. This new policy definitely leans heavily toward prioritizing domestic production.
But maybe that comes with some trade-offs.
Exactly. It's something to consider, especially as consumers. Are we willing to potentially pay higher prices for goods if it means supporting American jobs and businesses? It's a complex issue with no easy answers.
And that's why it's so important to look at it from all sides. And the sources we've covered today have done a good job of that. We've seen the administration's reasoning, the potential downsides highlighted by economists, the market reactions, and the global response. It's a lot to digest.
If manufacturing does start coming back to the U.S. in a big way, how will that change things? Will it affect where people live and work? Will it shift power dynamics between countries? It's something to think about as we watch this all play out, because the economic impact is just one piece of the puzzle.
Lots to think about.
Lots to think about.
Hey, Micky. We always love digging into these complex topics, especially with everything going on in the tech world right now.
Absolutely. You bet.
And you reached out with some really timely questions about tariffs and their potential impact on, well, Apple.
Yeah.
It's your biggest holding, so no surprise. You're a little concerned about what these proposed Trump tariffs could mean for your Apple stock. And then we'll also be taking a look at those semiconductor ETFs you're tracking, SOXX and SMH,
Right.
and exploring why XLK might be a good move for you as well.
Exactly, Micky. We've been poring over all sorts of stuff. Analyst reports, financial news articles.
Wow.
Even going back into Apple's history to give you the full picture.
Okay.
The goal today is to really cut through all the noise and give you those clear, actionable insights into, how vulnerable Apple really is to these tariffs and their long-term prospects, of course.
Yeah.
And we'll also be dissecting the whole semiconductor ETF landscape
Sounds good.
with a focus on your specific investment concerns.
All right, so let's kick things off with Apple. It's amazing to think that this tech giant started in a garage back in '76.
It's incredible.
From selling a motherboard, the original Apple,
Yeah.
to becoming this global force.
It's quite the journey.
I mean, think about it. The Apple II that got the ball rolling, the Mac, that made user-friendly design accessible to everyone.
Right.
The iconic iMac, then the iPod, revolutionizing how we listen to music, and then bam, the iPhone.
It's a remarkable story of innovation.
It really is. It's been quite a ride, fueled by that relentless pursuit of design and that incredibly sticky ecosystem they've built. And of course, you have Tim Cook stepping in after Steve Jobs and really scaling the operations to the massive level we see today. It's a real testament to his leadership.
It is. And what's fascinating here, Micky, is how that legacy of innovation, that super strong brand loyalty,
Yeah.
it could actually provide a bit of a buffer against potential headwinds like these proposed tariffs.
Interesting.
But let's dig into the specifics of those tariffs first.
Okay.
So as of April 2nd, 2025, we're hearing about a 10% baseline tariff on all imports.
Right.
And the possibility of even higher reciprocal tariffs that would target specific countries.
Huh.
Now, for Apple, the most vulnerable parts of their supply chain are China, Vietnam, and India.
Yeah, no surprise there. China's the big one. We're looking at a potential 34% tariff, and they're still the main production hub for about 90% of iPhones.
Right.
55% of Macs, 80% of iPads. Then you've got Vietnam facing a possible 46% tariff.
Wow.
And they handle a sizable chunk of iPad and Apple Watch assembly. And then there's India,
Yeah.
where Apple has those ambitious plans to increase iPhone production to 25% of their global output.
They're really trying to diversify.
They are. They're currently at 10 to 15% with a goal of reaching 15 to 20% by the end of this year. But they could get hit with a 26% tariff.
Those are some pretty significant increases.
They are. These are some serious numbers we're talking about.
Absolutely.
Yeah.
And just looking at the China tariffs alone, we're estimating an extra $8.5 billion in annual costs for Apple.
Yeah.
Yeah. And that could mean a reduction in profit per share of about 52 cents, which is roughly a 7% hit to their profit margin.
Right.
And when you factor in the potential impacts from Vietnam and India,
Right.
some analysts are predicting the total revenue impact could be somewhere between 8 and 10%.
Wow.
Now, these are just estimates, of course,
Sure.
but they give us a pretty clear picture of the potential challenges Apple's facing.
Yeah. Talk about an immediate impact. The stock even dropped about 6% on April 2nd when this news started circulating. But, it's not all doom and gloom.
Not at all.
I mean, Apple's sitting on a mountain of cash. Over $60 billion in reserves from the last fiscal year alone. That kind of financial strength has to give them some options.
It does. It gives them flexibility to maneuver and make strategic decisions.
Right. Plus, they've announced those major plans to invest $500 billion in the U.S. economy over the next 4 years.
That's a huge investment. It shows their commitment to the U.S. market.
It does. And we can't forget about their software services business. It's a powerhouse, growing at 14% in the last quarter with a 75% gross margin. That's got to give them some wiggle room to potentially absorb some of these costs.
It definitely provides a cushion.
Yeah.
And that 14% growth in services with a 75% margin,
Yeah.
that's not just a random number.
Yeah.
It represents a really important shift for Apple towards a more stable revenue stream, one that isn't as directly affected by manufacturing costs and tariffs.
That's a good point.
This growing services segment Gives them some breathing room to handle potential dips in hardware sales. If they have to increase prices or if consumers are resistant to those increases.
Okay, yeah, that makes sense. But then the question is, how much of these costs can they realistically pass on to us consumers before we start pushing back? I mean, we're already seeing premium pricing across a lot of their product lines, and there's a limit to what the market will accept.
Absolutely. That's the balancing act they have to figure out.
Right.
And then you have to consider the possibility of retaliation from China.
Oh, yeah, that's a big one.
Apple makes a significant portion of their revenue, about 17% from the Chinese market.
Wow.
If China decides to make things difficult for Apple, that could be a huge blow.
Definitely. And on top of all that, they're still dealing with antitrust investigations here in the U.S. And the EU's Digital Markets Act, which is impacting their App Store commission model. It's like they're fighting fires on multiple fronts.
It's a challenging environment for sure. But, it's not all bad news.
Okay, so what are some of the opportunities they have?
Well, we're already seeing them try to shift more production to countries like India and Vietnam.
Right.
It's not an overnight solution, but it shows they're thinking long term.
Yeah.
And their ongoing investments in U.S.-based manufacturing.
Yeah, like their partnership with TSMC in Arizona.
Exactly. That could give them a strategic advantage down the road, reducing their reliance on China. And as we mentioned before, the continued expansion of their software and services ecosystem, things like iCloud, Apple Care, Apple TV Plus.
Yeah.
That's crucial for diversifying their revenue and boosting their profitability.
And it's interesting that there's this almost unspoken belief that Apple's brand loyalty is so strong
It is.
that they can pretty much set their own prices, especially for their flagship products like the iPhone.
Yeah, people are really embedded in their ecosystem.
They are. But even with that diehard loyalty, there's a tipping point, right?
Absolutely. There's a price point where consumers will say enough is enough and start looking at alternatives or just hold on to their devices longer.
Exactly. They're walking a tightrope between keeping their profits up and maintaining their market share.
It's a delicate balance, for sure.
So, Micky, from my perspective, the big picture for Apple in the face of these tariffs, well, it's definitely challenging in the short term.
Yeah.
We're probably going to see some cost increases.
Oh, boy.
And some stock volatility.
Most likely.
But their strong financials, those huge cash reserves, and their moves to diversify their supply chain and grow that services business, they all suggest that they're pretty resilient in the long run. The real questions are how China's going to react to these tariffs. And how sensitive consumers are going to be to price hikes.
Those are the key unknowns.
It's a situation that needs to be watched closely, and Apple needs to be ready to adapt quickly.
Absolutely. Agility is going to be key for them to maintain their position in the tech world.
Okay, so that gives us a good rundown of the Apple situation and those potential tariff impacts. Now let's shift gears and talk about those semiconductor ETFs you're interested in. SOXX and SMH.
Okay.
And why XLK, which you also hold, might be worth considering. Right now, semiconductors are the foundation of the whole tech world.
They are. They're the building blocks of everything.
But it's an industry that goes through cycles.
It does. You see downturns when the global economy slows down, which then impacts demand for everything from smartphones to data centers.
Right. And for ETFs like SOXX and SMH, which hold big stakes in leading semiconductor companies like NVIDIA, TSMC, Broadcom, and ASML, there are some specific risks within the industry that we need to think about.
For sure.
I mean, just look at the pace of innovation. It's relentless. A failure in a key technology, like a setback in the development of next-gen AI chips or EUV lithography.
The technology used to manufacture advanced semiconductors.
Exactly. That could have a domino effect across these companies.
Absolutely. And then there's the increased competition, especially from China's domestic semiconductor industry that's growing so rapidly.
Yeah, that's a factor.
That could put a lot of pressure on the market leaders.
And of course, we can't forget about the ever-present risk of supply chain disruptions.
Oh, definitely.
Which could be triggered by geopolitical tensions.
Like what's happening around Taiwan.
Exactly. Given how dominant TSMC is, or even natural disasters that could hit production facilities.
Right. Those are factors you can't predict, but you have to be prepared for them.
And the geopolitical situation around Taiwan always adds another layer of uncertainty.
For sure.
When we talk about chip manufacturing.
Absolutely. It's a major risk factor.
Then there's the whole AI boom. What if that hype cools off? I mean, a lot of the recent growth in these semiconductor companies has been driven by the huge demand for AI processing power.
It has. And if that demand slows down, it could have a big impact.
Plus, let's not forget about the overall economic environment. Interest rates have been rising, and that can put a squeeze on growth-focused tech stocks, right?
Yeah, we saw that back in 2022.
Right. The Fed's interest rate hikes throughout 2022 created a tough environment for growth stocks. And semiconductor companies, which often trade at higher valuations because of their growth potential, they were definitely affected. And if you look back even further, the dot-com bubble bursting in 2000 had a devastating impact on semiconductor stocks.
It did. The SMH ETF saw a huge decline.
So these historical examples really highlight how volatile the sector can be.
They do. It's important to remember that when you're considering these investments.
So looking ahead, let's imagine a few different scenarios for the next 3 years or so.
Okay, sounds interesting.
What if the global demand for AI just keeps exploding?
Right.
Or maybe we see a massive expansion in software demand with more and more services moving to the cloud and relying on increasingly complex applications? And then the wild card. What if Apple comes out with some revolutionary killer app?
A game changer.
That totally reshapes the tech landscape. How might these different futures play out for SMH and XLK?
Those are great scenarios to think through. Let's start with SMH, the semiconductor ETF. As we said, its top holdings are heavily concentrated in companies like NVIDIA, TSMC, and Broadcom. If the demand for AI chips keeps surging or even accelerates, SMH is in a great position to benefit directly.
Makes sense.
Companies like NVIDIA, which is the dominant player in high-performance GPUs used for AI, and Broadcom, with their growing portfolio of AI-specific integrated circuits.
Okay.
They could see substantial revenue and profit growth,
Right.
which could lead to some really good returns for SMH investors. Some analysts are even predicting gains of 50 to 70% over that time frame if the AI chip market continues its rapid expansion, growing at, say, 30 to 40% annually.
Wow, those are some impressive potential returns.
They are. It could be a very profitable investment if that scenario plays out.
But what about those other scenarios? How does SMH fare if we see a software boom or if Apple drops this game-changing app?
Well, in a scenario where software demand explodes, SMH would probably see some indirect benefits. The increased demand for cloud computing infrastructure and data centers would require more powerful semiconductors, which would boost sales for the companies in the ETF.
Okay.
But it wouldn't directly capture the profits made by the software companies themselves.
I see.
And if Apple released a killer app, the benefit to SMH would be even more indirect, mainly through TSMC, if Apple relies on them to make any new specialized chips needed for the application.
Okay, so SMH is very closely tied to the performance of the semiconductor industry.
It is.
Which is great if that sector takes off, but maybe not so much if other areas of tech do better. Now let's look at XLK, the Technology Select Sector ETF. It includes giants like Apple, Microsoft, and NVIDIA, giving it a wider reach. How does XLK stack up in those same scenarios?
XLK offers a more diversified approach to the tech sector. It would still benefit from strong AI demand because of its holding in NVIDIA. But the weighting is lower compared to SMH.
Okay.
Where XLK really shines in these other scenarios is its direct exposure to leading software companies like Microsoft.
Right.
If software demand takes off Microsoft's Azure cloud services and their suite of AI-powered software tools, as well as other software companies in XLK, would directly contribute to its growth and performance.
And what about that Apple wildcard? That seems like a potentially big deal for XLK, since Apple is usually a significant part of that ETF.
It is. And you're right, that's a major advantage for XLK. Any big win for Apple, like a groundbreaking new product or that killer app, would directly boost XLK's performance. This direct exposure to Apple is something that SMH doesn't have.
So it sounds like XLK might be a bit more stable and potentially offer more balanced growth across different tech subsectors because of its diversification.
That's a good way to put it.
But it might not have the same potential for those explosive returns if semiconductors end up dominating the tech world over the next few years.
You've got it. It comes down to a trade-off between stability and explosive growth potential.
To make this clearer, let's imagine a scenario where we see solid growth in all three areas, AI software and a successful new product or service from Apple.
Okay.
In that case, XLK might offer a more stable and potentially higher total return overall because it's benefiting from all three of those trends.
Exactly. It's capturing gains from multiple sources.
Whereas SMH's returns would rely more heavily on the performance of the semiconductor market alone.
Right. It's more concentrated.
So, Micky, if you're convinced that AI is going to be the driving force in tech, then SMH might be the more aggressive play with higher potential rewards. But if you're expecting more balanced growth across AI software and maybe a big win from Apple,
Right.
XLK seems like the more robust and diversified choice.
It's about choosing the right tool for the job based on your investment outlook and your risk tolerance.
So to wrap up this deep dive for you, Micky, we took a close look at Apple and saw that even though they're facing some serious tariff challenges, their financial strength and their efforts to diversify their supply chain and grow those higher margin services should give them some staying power in the long run.
Right.
When we looked at your semiconductor ETFs, SOXX and SMH, it became clear that their future is very connected to the AI boom. They offer potential for high growth, but with more concentrated risk.
Absolutely.
XLK, on the other hand, gives you broader exposure to tech,
Right.
including those key software companies, and a significant stake in Apple,
It's a more diversified bet.
potentially offering a more balanced and stable path for your portfolio.
Exactly.
And here's one last thing for you to ponder, Micky. Given Apple's growing investments in U.S. manufacturing and the strong growth of their services revenue, how might a shift in their business model,
Right.
one that gradually moves away from relying so much on iPhone production in China,
It's an interesting question.
how might that impact their vulnerability to future trade issues and their overall valuation?
It's a great point. Something to keep in mind as you evaluate your holdings and think about how the tech landscape is changing.
Thanks for joining us for another deep dive, Micky.
It's always a pleasure to have these conversations.
We'll catch you next time.
See you then.